Next is learning objective number 4, which is one of the main topics of this chapter, and it deals with accounts receivable and uncollectible, otherwise known as bad debt. So the background is when a company delivers product to a customer on credit or on account, it's very, very common. The sale is earned because the goods or the services have been rendered, and therefore the customer recognizes that he or she owes the company. At that point, we recognize the transaction. So even though no cash is moved, receivables goes up because money is owed to the company, and revenue goes up because the company has earned its revenue, either by, again, delivery of the goods or services. Next, when the customer pays the bill, let's say it's $100, and a customer bought $100 worth of product. When he or she gets around to paying us the $100, we don't count revenue again because we recorded it when we shipped the product. But we do have a reduction in an asset. No longer does somebody owe us $100, they paid us off the $100. Cash goes up $100, and accounts receivable goes down by $100. We've kind of closed the loop. At that point, we got $100 in cash, and through the 2 transactions, we recorded $100. So life is good. Now, what happens if a customer does not pay the amount owed? And this could be because the customer has no money, or they're declaring bankruptcy, which is the ultimate, has no money, or they dispute it. They never got it. You shipped it to me, but I never got it, so I'm not going to pay for something I never got, right? A dispute. In this case, there is an occasion of an uncollectible account or a bad debt. And we'll see how we do these in specific detail in the coming slides. Accounting for bad debts is a little tricky under GAAP because GAAP requires us to estimate for receivables how much we think we are not going to collect. In other words, we can only show in the accounts receivable balance what we think we will collect, not what is owed to us. And likewise, on the income statement, we must reduce our profit for the amount of losses that we think will occur from people not paying us. That's an estimation of the bad debt. One way to think about it, because it may sound trivial, is let's say that you've sold $10 million in sales. Do you think you're going to collect all $10 million? You'd like to collect all $10 million, but you may not. When you say, well, I think 1% of the $10 million won't pay me. Of the 10 million, 1% or 100,000 you think won't be paid. If you're being kind of objective about it, your receivables would be 9,900,000 because you have this 100,000 you don't think you're going to get. And your revenues won't be 10 million. It'll also be 9,900,000 because that's what we think you're going to get net of this uncollectible account. We're going to see the mechanics of accounts receivable because, like I said, this is a very important part of everyone's business. First, it all starts with a sale. We have a sale on credit, and the example here is we sold goods on account for 100,000, and that also leads to this estimate of, I think we won't collect 2.9% of it based on our historical analysis. So I'm going to break out into an Excel spreadsheet here. I'm going to put on an R template because we've been using it, so I want to be consistent. I've hidden some of the columns so it all fits nicely on a piece of paper or a screen. You'll see here on transaction number 1 that we have a sale on account. We have accounts receivable going up by 100,000 because people owe us money. It's an asset to the company. And we record over here that we have revenue 100,000 because we did the work to record 100,000 revenue. Revenue is a good thing. It causes net income to go up, which affects retained earnings up 100. We won't record the cost of goods sold here because we're focusing on revenues and receivables. But normally we would record the revenues with the cost of goods sold so we don't forget it. So next we have to establish this estimate on collectible amounts. Here we said we establish an allowance for $2,900. We have an estimate for bad debt, and this is an unusual transaction, so hang on a little bit. We have this thing called a contra asset account. We've seen this before in the case of depreciation, and a contra asset account there was accumulated depreciation. But here we have an accounts receivable of 100, and next to it we'll have this allowance account, which is a contra asset account, in this case against receivables. And the amount estimated is 2.9% out of 100 is $2,900. And notice it's a negative. It's a negative because we don't think we're going to get the full 100. We're going to create a reserve of 2,900. So the net of the two, 97,100, is what we think we're going to ultimately get. Same thing over here. We have this bad debt expense, which is a negative to the net income. So therefore it's negative there, negative there. What it's doing, again, is offsetting this 100 that we don't really think we're going to get all 100. So that's how we establish a reserve. Now, at this point in time, nobody's not paid us. We just think that on average, 2.9% won't pay us, even though we don't know who that's going to be at this point. So that's the initial recording. So here we have accounting, starts with a sale and credit, and we establish this account. Next, we hope they pay us, but what if they don't? In this case, let's say $500 of that receivables from a customer who went bankrupt. So we're not going to get it. To count it as receivables would be not correct because we know we're not going to get it. But we knew somebody wouldn't pay us, and now we're going to use some of that reserve. So that's the idea, is that we don't record bad debt as something bad occurs. We anticipate it, record an allowance, and then when bad things occur, we then use this reserve. In the accounts receivable column here, we see that we started with 100,000, but now we know 500 of it will never happen. So let's get rid of it now so that the gross amount we think we could get reflects that. Then, instead of recording a bad debt expense, we record it against the allowance account, or sometimes they call it a reserve. So we'll use some of the allowance or some of the reserve to absorb this $500. And notice on this side, on the revenues and the expense side, there's nothing, right? Why is there nothing? Because we have already taken care of it, because we're using the reserve method. When we look at the accounts, when somebody doesn't pay us, we reduce the asset account and we utilize some of the reserve. And that's all there is to it. So it's a relatively simple transaction to write off a bad debt. Next is we go through the year, and before we report to our shareholders and other users of our financial statement, we have to look at our receivables account and say, okay, we have a gross amount of receivables that people owe us still, and we have an allowance account given all the ins and outs of creating reserves and using reserves. So now we have a receivables gross, we have an allowance account which offsets it, and then we have a net. So then we look at, well, is it good enough? And again, this is one of those accounting estimate things. How do we know if it's good enough? The way we evaluate it is called, one method is called aging, like getting old. So aging is illustrated here, where we have receivables broken out to how old are the receivables. The first group are current, which means we just sold them something, so nothing's happened yet. Others are past due, so let's say it's due in 30 days, but they haven't paid. So now it's mildly concerning because they haven't paid us yet. The other might be 61 to 90. Oops, it's getting further out. And then the last is over 90 days past due. Now there's trouble. Like they should have paid us in 30, that they didn't pay us by 90, something's wrong. Either they have trouble with money or they are not going to pay it because they dispute, but something's wrong there. This center column in yellow shows what percent probability do we estimate will be uncollectible. It's kind of a fresh receivable, like we're going to get most of it. So in this case, 2% is our estimate of how much it won't pay. But as we go to older and older and older receivables, then our fear of non-payment or non-collection goes up, and it goes higher and higher and higher. In the outside case, where it's way past due, over 90 days, we're estimating that 8% of that will not be due. When we multiply the amount of receivables times the percent we think is not collectible from that age group, let's call it, we end up with $2,900 out of $100,000. Again, these estimates in yellow are based on a company's estimates. There's no regulatory guideline, there's no schedule that's standard because it's very specific. What is the estimate for the experience and the customers and the times for the company? So that's how we do this aging to test whether our allowance is big enough. Now, let's say that we've done this nice analysis and we say we have $2,900 that we should have in our allowance. If our allowance only has, say, $2,500, then we go, uh-oh, we need to make the allowance bigger because in our best estimate, we think $2,900 won't be collectible. So we would then, no problem, we'll increase the reserve account by another $400 to get it up to our target of $2,900. And then we'll expense more bad debt of the same amount, $400. And that's to bolster our reserve and be more confident that our net accounts receivable balance is accurate. So that's why we do that. Next, how do we report? as we mentioned before, the receivables is presented on the balance sheet at a conservative number on how much we think we'll collect. And here you see it written there's a fairly common way to present it. Accounts receivable less allowance for doubtful accounts of these two numbers for the 2 years presented. And the right side is the gross minus the reserve equals the net. These two numbers represent the net amounts that we estimate we'll get from the years 2015 and 2014.